feel like the market's speaking language you just don't understand. Like there's some secret code to all those ups and downs.
Yeah.
Well, today we're cracking that code with a deep dive into technical analysis.
I like it. Cracking the code.
You're in the right place if you've ever looked at a candlestick chart and felt more lost than a flea in a dog show. We're ditching the jargon, sticking to the good stuff. The insights that make technical analysis so powerful. And to guide us through this fascinating world, we've got an expert who sees charts in their sleep.
Maybe not in my sleep, but close enough. I do love me some charts.
Let's dive in. So what is technical analysis?
Well, it's funny you should put it that way. It's like throwing out the traditional rule book on valuing a company. We're not looking at earnings reports or product launches really at all in the same way.
So no more obsessing over quarterly reports. Tell me more.
Exactly. Instead, we're diving into the world of charts, studying the history of a stock's price and volume to see if we can spot patterns, anticipate where it might go next. It's all about reading those clues, understanding the psychology of the market, those waves of buying and selling.
It's funny you should say that. Just last week, I was about to buy this stock. Everyone was raving about it. The company seemed solid. Then I noticed the trading volume was super low. Like everyone was whispering about it, but no one was actually buying.
Interesting.
So I held back. And guess what? The price tanked a few days later. It was a small win, but hey, I'll take it.
That's a perfect example of how even a basic understanding of technical analysis can give you an edge. It's about understanding that a company's perceived value, at least in the market, doesn't always match its fundamentals.
Right. It's like realizing that sometimes the loudest voices in the room aren't always the most insightful. But let's get back to why this all matters. Can you give me the rundown on why someone would care about, these squiggly lines on a chart? What's in it for them?
It all boils down to gaining an advantage. Technical analysis empowers you to navigate fast-moving markets, set those crucial risk parameters, and even estimate potential profit targets. Think of trading legends like William O'Neill with his Can Slim system, or Paul Tudor Jones, who famously predicted Black Monday using, you guessed it, technical analysis.
Wait, rewind. Paul Tudor Jones made millions using this stuff.
He did.
You have to tell me more about that Black Monday prediction.
So picture this. 1987, everyone thinks everything's hunky-dory in the market. But a technical signal called the inverted yield curve starts flashing red. Imagine this. Short-term interest rates are higher than long-term rates. A total head-scratcher that usually spells trouble.
Okay, so something's off. But how does that translate into a market crash?
Well, this inverted yield curve is often a precursor to a recession, a big red flag for the market, and bam, Black Monday hits. The biggest single-day market crash in history at that time. Paul Tudor Jones, armed with this technical insight, sees it coming, shorts the market, and makes a killing.
Wow. Talk about a powerful example. But I have to ask, it can't all be sunshine and rainbows, right? What's the catch?
You're right. Technical analysis isn't a crystal ball. It requires dedication to learn, and misinterpreting the signals is easy if you're not careful. It's like learning a new language. You wouldn't expect to speak it fluently overnight.
So it's not just about picking up a few tricks. It's about really understanding the nuances of this language.
Precisely. And just like any tool, it has its limitations. Relying solely on technical analysis without factoring in things like company news or economic conditions is like navigating a maze blindfolded. You need the full picture.
A recipe for disaster. Got it. Technical analysis. Powerful tool, not a guaranteed path to riches. With that in mind, let's roll up our sleeves and dive into the nuts and bolts, shall we? All right, let's talk charts. I'll admit they used to look like hieroglyphics to me.
Charts. So bad once you get to know them.
But I have a feeling you're about to change that.
Well, think of a chart like a treasure map, right? And we're on the hunt for the X that marks the spot, those potential trading opportunities.
Okay, I'm all about finding that treasure. So what are the landmarks? What should we be looking out for?
So you've got your support and resistance levels. Those are key.
Okay.
Always got to watch the trading volume. That's huge.
Right.
And then, of course, those elegant candlestick charts. Each one's revealing a piece of the market's story.
All right, map in hand, let's break this down. Starting with support and resistance levels. What's the deal with those?
Okay, so imagine a stock price like a bouncy ball, right?
Okay.
Support acts like the floor. It's a price level where buying demand is strong enough to prevent the price from, dropping further.
Okay.
Resistance, on the other hand, is like the ceiling, preventing the price from rising higher due to selling pressure.
So it's like this constant push and pull between those buyers and sellers, creating these price boundaries.
Exactly. And you often see these levels form around psychologically significant price points, like a stock hitting that nice, even $100 mark. People see that round number and they react.
Yeah.
Either jumping in to buy what feels like a bargain or selling to lock in their gains.
It's almost like a self-fulfilling prophecy then. The more price bounces off these levels, the more, significant they become.
Precisely. And the more times that bouncy ball hits the floor or the ceiling, the stronger those levels become. Traders watch for those bounces to anticipate future price movements.
Okay.
Trying to get ahead of the game,
This is making so much more sense already. Okay, so we've got support and resistance, our price boundaries. What about volume? You mentioned it's important. How does it fit into all of this?
Volume is like the energy driving those price moves, right? Think of it this way. A high volume move is like a rushing river. It's powerful. It's more likely to continue in the same direction.
So high volume confirms a strong move, like everyone's piling into or out of a stock. What about low volume?
Low volume is like a gently flowing stream, right? It might be going somewhere, but it lacks that same conviction.
Yeah.
It suggests there's not a lot of trading activity behind the move, making it more prone to reversals.
Low volume, proceed with caution. Got it. This is like learning a whole new language for understanding market movements.
Mm-hmm.
Okay, you mentioned candlestick charts earlier, and honestly, those still seem a bit intimidating to me.
Candlestick charts, they're cool. They're like the emojis of the trading world. Each candlestick tells a story about the trading activity during a specific time frame. Could be a day, an hour, even a minute.
All right, walk me through it. How do I decipher these candlestick emojis?
Okay, imagine each candlestick as this visual representation of this mini battle between buyers and sellers, right?
Okay.
The body of the candlestick, the thick part, that tells you the opening and closing prices for that period.
Right.
So green candlestick, or sometimes they're white, means the buyers won the battle, closed higher than they opened. Red candlestick or black, sellers were in control, pushed the price down.
So green is good, red, not so much. What about those lines that stick out from the top and the bottom, the wicks?
Ugh. Those are the wicks, sometimes called shadows. And they show us the highest and lowest prices reached during that time. Long wicks can signal indecision in the market, like buyers pushing the price up, only to have sellers drag it back down, or vice versa.
So by looking at, a series of these candlesticks, we can see how this battle between buyers and sellers plays out over time.
That's it. And, certain combinations of these candlesticks form patterns. They become clues that can help us anticipate the market's next move.
Okay.
But we'll dive into those patterns a bit later.
Okay. I'm already starting to see the potential here. Before we move on to patterns, though, are there any other tools in this technical analysis toolkit we should know about? What about these technical indicators I've heard so much about?
Oh, the indicators. Yes. Technical indicators are like adding another layer of analysis, like putting on those X-ray glasses to see what's really going on beneath the surface.
I like it.
They take that raw price and volume data and transform it into signals that can help confirm what the charts are telling us.
Okay, so it's not just about the charts themselves. It's about using these indicators to, get a more complete picture.
Exactly.
What are some examples of these indicators?
Ooh, there are so many indicators out there. It's like a kid in a candy store.
Yeah.
But some of the most common ones fall into a few categories. You've got your trend indicators like moving averages. They smooth out the price fluctuations, help you identify the overall direction of the trend.
Okay.
Think of it like drawing a line through those bouncy ball movements to see if it's generally going up, down, or sideways.
So moving averages help us cut through the noise and see the bigger picture trend. What else?
Mm-hmm. Then there are momentum indicators, like the RSI, the Relative Strength Index, or the Stochastic Oscillator. These measure the strength of a price move and can alert you to potentially overbought or oversold conditions.
Okay.
Imagine a car going too fast. Momentum indicators are like the speedometer warning you that it might be time to hit the brakes.
Overbought, oversold. It's like the market needs to catch its breath sometimes.
Exactly. And lastly, you have volume indicators, like on-balance volume, which track changes in volume to predict potential breakouts. Remember that rushing river we talked about?
Yeah.
On-balance volume helps you identify when that river is about to burst through a dam.
Wow, so many tools to help us understand this language of the charts. It seems like these indicators offer some really valuable insights, but with so many options, it could be overwhelming to know, where to start.
Oh, absolutely. It can feel overwhelming. The key is to remember that no single indicator is perfect. They work best when combined with other indicators, chart analysis, all those things. It's like pieces of a puzzle. forming a clearer picture of potential trading opportunities. But enough about indicators for now. Let's move on to those candlestick patterns you were curious about.
Okay, let's do it. Okay, candlestick patterns. It feels like we're finally getting to the good stuff. I imagine these patterns like, secret handshakes of the market, and once you know them, you're in the club.
I like that. Yeah, these patterns are like footprints in the sand, right? Giving us clues about where the market might be heading.
Right, spill the tea. What kind of footprints are we looking for?
So we've got two main types of candlestick patterns. Reversal patterns. Those plot twists that signal a potential change in direction in continuation patterns, suggesting the current trend's here to stay, at least for now.
Okay, let's start with those reversal patterns.
Ew.
Give me the inside scoop on how to spot a potential U-turn in the market.
Okay, so imagine this. You're watching a stock climb higher and higher, like a rocket trying to break free from gravity.
Okay.
But each time it reaches a certain price level, bam, it hits a ceiling. That resistance level we talked about.
Right.
Gets pushed back down.
So it's like it's trying to break through, but just doesn't have the energy.
Exactly. Now, if this happens twice, forming two peaks at roughly the same price level, you might be looking at a double top pattern. It's a classic bearish signal suggesting that upward momentum might be fizzling out, and a reversal, a potential downtrend, could be on the horizon.
So two peaks and a potential plunge.
Yeah.
Got it. What about other reversal patterns?
Another one to keep an eye out for is the head and shoulders pattern.
Okay.
And it's named that for a reason.
Right.
Imagine this. You see a peak, then an even higher peak that's forming the head, and then another peak lower than the head forming that second shoulder.
Okay, spooky.
A little bit spooky, right?
So this head and shoulders thing, it's like the market's getting tired, makes one last effort to push higher before collapsing.
Yeah, you got it. It's often seen as a bearish signal, suggesting a potential trend reversal.
Okay, so those are reversal patterns, the market's way of, throwing us a curveball. What about those continuation patterns, the ones that tell us to hop back on the trend train?
Continuation patterns are all about those pauses, those moments of consolidation where the market takes a breather before continuing on its merry way.
Like a runner catching their breath before sprinting to the finish line.
Exactly. One common continuation pattern is called a flag, and it looks just like its name. Imagine the price moving sharply in one direction, forming that flagpole, and then consolidating in a tight rectangular range, forming the flag itself.
So the flag's like a pit stop before the race continues.
Precisely. A breakout from that flag pattern, either upwards or downwards, often signals a continuation of the original trend.
Makes sense. Are there any other continuation patterns we should be on the lookout for?
Keep your eyes peeled for triangles.
Okay.
They're formed by converging trend lines, like a funnel, narrowing that price action.
Right.
You've got your symmetrical triangles where the trend lines converge at roughly the same angle.
Right.
Ascending triangles with a flat top and upward sloping bottom. And then descending triangles with a flat bottom and a downward sloping top.
Triangles. That sounds more like geometry class than market analysis.
Right. It might sound complex, but the concept is simple. Triangles represent a period of consolidation, like a buildup of energy before a breakout. And that breakout often signals a strong move, either continuing the existing trend or potentially reversing it.
Wow. Who knew there was so much to learn from a few simple shakes? This is incredible. But I have to ask, how do we know if a pattern is legit?
That's the million-dollar question. Just like those footprints in the sand, not all patterns are created equal. Some are faint, easily mistakable, while others are bold and clear. It takes practice, experience, and a healthy dose of skepticism to separate the real deal from those decoys.
So it's not just about, memorizing a bunch of shapes. It's about understanding the context, the story those patterns are telling us, and looking for confirmation from, other indicators and tools.
Exactly. It's like being a detective, piecing together all those clues to solve the mystery of the market's next move.
I love it. Speaking of detectives, let's put on our metaphorical beer stalker hats and investigate how to turn all of this knowledge into actual trading decisions. So how do different traders use these patterns and indicators to, navigate the market?
That's where things get really interesting. Just like there are many ways to approach a crime scene, there are many trading styles out there. Some traders are like cheetahs, all about speed and agility.
Right.
While others are more like wise owls, patient and observant.
Okay, I'm intrigued. Let's break down these trading styles, starting with those speedy cheetahs.
Those would be our momentum traders. They thrive on volatility, riding those short-term price swings, like surfers catching a wave. They jump in when a stock is surging, often fueled by, news or a breakout from a pattern, and they're out just as quickly. aiming to ride that wave as long as the momentum lasts.
So quick entries and exits, high risk, high reward. Got it. What about those patient owls? They sound more my speed.
Those are our position traders. Think, long-term investors, the Warren Buffetts of the world.
Right.
They're focused on the fundamentals of a company, its intrinsic value, and they're not afraid to hold on to a stock for months, even years, riding out the market's ups and downs.
They're playing the long game, focusing on the bigger picture rather than those short-term fluctuations.
Exactly. They might use technical analysis to identify entry and exit points or to manage risk, but they're not making decisions based on every little blip on the chart.
So we got our cheetahs and our owls.
Mm-hmm.
What about something in between? What about those who like to strike a balance between, speed and patience?
Swing traders are our in-betweeners. They aim to capture those price swings within a larger trend, holding on to a trade for a few days to a few weeks. They often use technical indicators, candlestick patterns to identify those sweet spots, those potential entry and exit points where they can, maximize their profits.
So they're not as fast as cheetahs, not as patient as owls, but they've got their own unique rhythm. What about those adrenaline junkies? The ones who live and breathe the markets?
You must be talking about day traders. Yeah. They're the daredevils of the trading world, opening and closing positions within a single trading day. They live for those rapid-fire trades, profiting off those small but frequent price movements, glued to their screens, watching those charts like hawks. And they have to have nerves of steel.
Day trading definitely isn't for the faint of heart. And then there's scalping, right? Isn't that even more intense?
Scalping takes day trading to the extreme. These traders are like hummingbirds, flitting in and out of positions in seconds or minutes, aiming for those minuscule profits, often just a few ticks or pips at a time. It's a whole other ball game.
So we've got our cheetahs, our owls, our swing traders, our day traders, and our scalpers. That's quite a range. But no matter what your trading style is, there's one crucial element that applies to everyone: risk management.
Yes. Couldn't agree more. Risk management is like wearing a seatbelt while driving. It won't prevent every accident, but it can definitely save you from a major disaster.
Exactly. So how do we protect ourselves in this wild world of trading? What are the golden rules of risk management?
Rule number 1, and I can't stress this enough, only risk what you can afford to lose. Trading is inherently risky, and no one wins every trade. So before you even think about hitting that buy or sell button, determine your risk tolerance. How much money are you truly comfortable potentially losing on a single trade? A good starting point is 1-2% of your trading capital.
Don't bet the farm on any one trade. What else?
Rule number 2, always use stop-loss orders. Think of them as your emergency brakes. A stop-loss order automatically sells your position if the price drops to a certain level, limiting your potential losses on a trade.
So it's like setting a safety net just in case things don't go as planned.
Exactly. And finally, rule number 3, understand and manage your risk-reward ratio. This is about ensuring the potential reward on a trade justifies the risk you're taking. Aim for a risk-reward ratio of at least 1.2, meaning for every dollar you're risking, you're aiming to potentially make $2 in profit.
So it's not just about winning trades. It's about making sure those wins outweigh the losses in the long run.
Precisely. Risk management is all about protecting your capital, staying in the game, and giving yourself the opportunity to learn and grow as a trader.
This has been an amazing journey into the world of technical analysis. We've covered so much ground, from the building blocks of charts to those fascinating candlestick patterns, from the various trading styles to, of course, the absolute necessity of risk management.
And, the most exciting part is that this is just the tip of the iceberg.
It really is, yeah.
The beauty of technical analysis is that it's a lifelong journey of learning, discovery, exploration. Never gets old.
Well, any final thoughts for our listeners before we wrap things up? What's the one thing you want them to take away from this deep dive?
I think it's important to remember that technical analysis isn't about, predicting the future with 100% certainty. No one can do that. It's about understanding probabilities, managing risk, and using the tools at our disposal to make more informed trading decisions.
Yeah.
So, keep learning, keep practicing, and never stop exploring the fascinating world of technical analysis.
That's a fantastic note to end on. A big thank you to our expert for, demystifying the world of charts and patterns and for sharing their incredible insights. And to our listeners, thank you for joining us on this deep dive. Until next time, happy charting.